All right. So what I'll do is I'll take you from the start. What we're interested in doing is we want to calculate what is uh, the best portfolio that you can create if you have a limited number of stocks under your control. So in this case, we have 10 stocks that we have under our consideration, and we are going to find out how much money we should put in each of these stocks. Should we put all our money in the best performing stock? Should we put all our money in the lowest risk stock? What proportion should I put it accordingly that my overall return is the highest and my overall risk is the lowest? Now, this was provided by a great friend who I've not put his name, Mr. Markowitz, who won the Nobel Prize for it. And the steps and the methodology that we're going to follow is as follows. We're going to gather monthly returns for 3 months, not daily returns, monthly returns. So what it means is calculate the data you will get daily returns from the stock market. Use the daily returns, delete all the entries from the 2nd to the 30th of the month, only keep for the first of the month. And so we will have 3 points of data in that manner. From that, we will also we will do this for all the 10 stocks. We will repeat this for the Sensex or for the Nifty. You can choose any index. I'm going to choose the Sensex. And from that, we're going to calculate the following. Once we have these two information with us, we were going to calculate what is the average return over the period. We will calculate the standard deviation of the stock, the variance of the stock, the covariance between each of the stocks, between the stock and the index. From that, we will find the beta. And beta is the indicator of risk. We will find that is the total risk. We will also find what is called as systemic risk for the stock, and that systemic risk is the risk that the variance of the stock market itself. Uh, we will then use to find out what was the excess return, means what return we were getting over risk-free rate, and we will find the excess return to beta. Okay, that ratio of how much is the excess return to beta, and this itself is called the Sharpe ratio. So we're going to calculate the Sharpe ratio from this, and then we will find out we'll calculate a cutoff value, and that cutoff value will be found out in this formula. Okay, and from this we'll be able to understand what should be our what do you call our portfolio, means how much money we need to invest in each of the 10 stocks. Okay, so I had done a calculation, but unfortunately this calculation is of a previous period. This was maybe a few years back, so that is why the data may not be relevant. And what you finally get is something like this, which tells you if you have a proportion of money with yourself, if you have 1 rupee, that 1 rupee in what percentage is getting split over here. So as you can see, maximum is going into Sipla right at the bottom. You see 0.45 goes into one company. ACC gets around approximately 20%, 16% to Infosys, oil and national gas 13%, Bharti Airtel and Reliance get and Tata Steel 5%, 15 and 12%. And if you look at these stocks here, it is giving me a negative value. What it tries to tell you is as much as possible, maybe we may have to avoid these stocks or we'll have to short sell these stocks. Okay, so if at all we want to build up this market portfolio, these are the stocks we need to avoid. Unfortunately, it's giving very low ratings for HDFC Bank, State Bank, and Bharti BHEL. Maybe this was because the performance in the last 3 months would have been a little problematic, but this keeps changing. So you have to keep in mind whenever you create a market portfolio, this market portfolio is not set in stone. This market portfolio is the situation as on data received in the last 3 months. So if at all every 3 months you're supposed to recalculate, reassess, and if you get changes in market portfolios, accordingly you need to shift and move the way you invest your money. Now keep in mind, this can be used not just for equity, this can be used across asset classes. So you can use this even for gold, you can use this even for bonds, you can use it for housing properties, you can use it for any valuable commodity or goods that is there in the market, including a service. So let us go on with the steps. A second. Yeah. So I shall keep this back on my screen 1 second. Yeah. So everyone can see all the 10 companies. We will go now to Bse India first. So what I do is I'll open up a new screen to help you out. www.bseindia.com. You enter there. Once you enter Bse India, you will find market data. There you have it. So you have market data products, which is given over here. I'm moving my cursor to help you identify. Click on market data products. From market data products, you can now go to market data. Okay. Again, I'm highlighting that for you. There's market data there. Please click on market data. When you click on market data, you scroll down to historical stock prices. Okay. So you can get to historical stock prices. Click on the historical stock prices. Actually, you can do another thing. Like, yeah, historical stock prices. Oh, I got an easier way to get it done for you. No, we go to historical stock prices. From there, in equity, let us go to the first security that we've been asked to find. Okay, so the first one is ACC. We select ACC. We want 3 months of data. So we click on monthly from October 2021 all the way down to, oh, so maybe just put from October, it'll give you all the way till today, present. We hit submit and we get our information down. There you have it. So the information is readily available here. You can download the Excel file if you want. There's a small download button. If you click on this, the file gets downloaded. There is another button on the top right corner somewhere. Yeah, there. So you click on it and you get it. Now what I can do is I can directly take what I'm using is my opening prices. So I will use my opening prices for calculating all this information. So once again, let us go to our trusted friend spreadsheet. Under Microsoft, it's called Excel. Under Google, it's called spreadsheets. You can go to any one of them as such. And let us create a basic outline. So what we'll do is we will have here to calculate uh, portfolio, Markowitz, market portfolio. I hope everyone is doing this as I am doing it. Maybe a little slow, but it's okay. But please continue. First, I'm going to have my serial number, name of stock. No, sorry, stock one. So stock one, stock two, yeah. I will take all my companies. First one is ACC. So there is ACC. Let me okay. I'm zooming it a little so that it becomes easier for you guys to see. The second one is Bharti Airtel. The next one is Bhel, Cipla, HDFC Bank. Then there's Infosys, ONGC, Reliance, Industries, State Bank of India. Just call it SBI. We call this RIL. We all know it's HDFC Bank. So. And last one is Tata Steel. Okay, so we have our companies given here. We need to add one more piece of information, that is the month. So 1, 2, 3. So 3 months is what we're going to calculate. So for the first month, it is October, November, and December. Is this part clear to everyone? What we've done? Fairly easy.
Yes, sir.
Yes, sir.
So now what we'll do is let us go back to our sheet. We have our opening prices given here. So it is 2239. Just blindly copy this first. Okay, it's given us a lot of data which we don't want. And yeah, so I have ACC. In the same way, I am now going to calculate, I'm going to get all the other data also. So instead of ACC, I'm going to type BHEL now. Look at the camera. Huh. So I have Bharat Heavy Electricals, same period, October 2000 thing, hit on submit. And there you have it, Bharti at the bottom. Once again, we're going to go to opening prices. I'm going to select this. I'm going to paste it, delete all the other information which is not required. Paste Bharti at, sorry, this was BHEL, right? Yeah, BHEL. Next, we take the company Bharti Airtel. There you have it, Bharti Airtel. Submit. So again, the opening prices have come. Copy, take what we need, paste it, go to
Sir, we are supposed to take opening price or closing price because you
opening.
have taken closing.
What? Okay. I took opening prices everywhere. I took opening prices, right?
Sir, you
668.
have taken a high price. See,
What?
714.
Sorry. I took the wrong thing. I took the wrong thing.
Sir, for all the companies.
What? I did that?
Yes, sir.
Yes, sir.
And what are you all doing so long? Sleeping, huh? All of you all?
Sir, I was just confirming that. Let me ask you first.
Chalo, let us repeat it once again. ACC. Okay, wait. Since Bharti is open, we're going to start with Bharti. Oh, what will come? Yeah, once again. Okay, I think now it will come. There you have it. Okay, now it's clear.
Yes, sir.
Chalo. So Bharti is done. BHEL. Oh, sorry. Bharat Heavy Electric. Submit. BHEL has come. We go down, take our data, just in this. Next, we go and take ACC. See, I make a lot of silly mistakes. That's why I never got 100 out of 100 in maths. Always got low marks in maths. And not because I didn't know the formula. I knew all the formula, but always while noting down, like while, suppose while writing 67, I would write 76 and I would lose marks. Or in calculations, I'll miss one step, directly jump to the next step. I won't take the right numbers. Always lost marks that way. Sipla. Okay. HDFC. Oh, no, sorry, sorry. I took the wrong HDFC. HDFC Bank. Submit. So my HDFC is there. I'm going now to Infosys. Submit. Actually, the data is easy, but I could have taken 10. No, actually, but even 10 months has a problem. 1 year has a problem. ONGC. Okay, has anyone asked me a question? Like earlier, we used to do all our calculations for years, 3 years, 5 years, 10 years. Now, why are we doing it only for 3 months? Has this question come up in anyone's mind?
Yes, sir.
Yes, sir. So, what is the reason? Can you figure out?
Yes, sir, to get accurate data, latest data.
Then only take last week's data. Why stop at 3 months? Why not just take yesterday and day before yesterday? 3 days data.
So one reason can be that since like after pandemic now the market is being stable. So last
No,
3 months.
not the right reason. I mean, that is a contributing factor, no doubt, and it plays an important role into why we take 3 months. Pandemic is an example of why we take 3 months. But what is the reason we take 3 months? Anybody else would like to try?
Sir, we are calculating it for 1 month
Sorry, come again.
because we are calculating it for 1 month.
Hmm. No, no, not the right answer I'm looking at. I'm asking the reason. Why do we do it? We're doing it for 3 months. You are saying do it for 1 month. I'm asking why do you say 1 month? That is my question. Why just 1 month? Or why 3 months?
Quarterly results are declared. So
Nope.
gives quarterly results.
Nope. Or Tata Steel has not. What? December data is missing. Tata Steel. Something is wrong in Tata Steel. Okay, what we'll do is, since Tata Steel's this is not there right now, what I'll do is I'll use the last entry of this one to save it as the next entry also. Okay, so with this, we now have a nice little monthly statement uh, of all our companies' closing price. Okay, let us put some lally lipstick to make it look good. Okay, because anything should look good. Okay, so we have the basic information. Now, you all with me? Sorry. Yeah. Oscar. Mm, this. Give me a second. I use this format. Here, what I'm going to do is I'm going to put the returns. So the first one talks about the returns that you. The first one talks about the opening prices. The second one talks about the returns that you get for the 3 months. All right. So this is what we're going to calculate. Now, we all know in order to calculate returns, what is the formula that is used? How do you calculate percentage returns? People, how do you calculate percentage returns?
Initial minus final divided by final.
Wrong. Final minus initial divided by initial. Such an easy formula. So final minus initial. So for the month of December, December will be final, November will be initial. Okay, so that's what we're going to do. For December, December is final. First put a bracket, plan in advance. December minus November, that is final minus initial, divided by initial, which is November. Everyone see the formula?
Yes, sir.
Okay. So we get negative returns for December. And if we copy this formula one step up, we get positive returns for November. So in November, November will be the final and October will be the initial. So it is November minus October divided by
November.
no. My initial for November month, which comes initially? October or November? Ria. My God, people are
October, sir.
so yeah. So why are you telling November then? See the formula percentage returns is equal to final minus initial divided by initial. Okay. How hard is this formula, people? How hard is it? Sorry, where am I going? Looking at this formula for the month of November, Ria, repeat after me. What is final? For the month of November, what is going to be final?
November.
Yes. What is initial?
October.
Divided by?
October.
Very nice. Okay. Fairly simple, right?
November minus October divided by October.
Thank you very much. Okay. So there you have it. I'll keep this formula in the side over here so anyone can refer to it. Uh, Second. Okay. Now, if I only copy and paste this formula, it will get copied everywhere, and I have the data with me ready. Is that clear?
Yes, sir.
Okay, so I've copied this formula. Now, obviously, these will be not applicable because can I calculate data for October?
No, sir. For that, we need the data of
September.
September also.
Wow, thank you very much. This is exactly what I was expecting from you. So it is not applicable. We won't get data for October right now because we've taken only 3 months data. Actually, I realized I made a small mistake. If you look at the, the methodology, it says get monthly returns for 3 months. Oh, actually, it's not wrong. Actually, what I've done is finally right. It's right, right. Okay. So now what we'll do is let us calculate the basic information. So let us create another cell, and we will call. So we'll call this the parameters of the 10 companies. So what are the various parameters that I'm interested in calculating? So let's go back to our trusted little methodology. And it says first monthly returns for 3 months, which we have calculated already on top in the second table. Now it says gather monthly returns for the same period of an index. Okay. So what we'll do is we will tweak this a little. I'm zooming out slightly. I will add another column here. Okay. I'll delete all this data and I'll call it the Sensex. Wow. I didn't realize Sensex has a very funny word inside it. It's okay. And to distinguish this, what we'll do is we will highlight it slightly differently. So we will call it home. Fill this color. Yeah. Okay, so we are distinguishing this by this one. I will go back to our trusted stock exchange. We will go back one level, and here where we had gone to equity, if we scroll down a little, we scroll down, scroll down, scroll down, we come down to indices. You can see indices right here in blue. Click on indices, and now indices will open. So we're looking at indices historical prices. So click on historical prices. So we go to the index that we want. We're going for the Sensex traditional 30. We want monthly information, and we want from October all the way from October 2021. Yep, and hit on submit. So there you have it. I have all the prices from October all the way now. Uh, let us click on select the figure we need, insert the text. So Sensex data is coming in the Sensex column over here for the month of October. I'm taking opening data for November, and I'm placing it in November. And last, I'm going to take December. I'm going to place it in December. So you have it there. Very easy. Copy all this stuff over here, and we get our returns also. How easy was that? Super easy, right?
Yes, sir.
Okay. So now let's get on to the other parameters. So we have, now let us go back to our methodology sheet, our guide, our digest, if you sort of want to take that name. We've done point number 1, And we have done point number, so let us say, point number one, I'll highlight it in green. And point number one is done. Point number two also is done. Now we've come to the calculate part. Okay, we were there in point number three, we're calculating. Let us calculate the average return, standard deviation, variance, and covariance. Now, all of this you know really well. What we will do is we'll call this parameter. So we want average return. I'll make all the one standard deviation, variance, fourth, fifth, sixth, we require covariance, we require beta, we require risk-free return. So instead of risk-free return, we write it that way. Seven, we look at total risk and systematic risk. Okay. From this, we are going to calculate the Sharpe ratio, and we are going to calculate the weights. Because people will say, what the hell is weight doing over here? How can stocks have weights? But they do if you invest it in a portfolio. Okay, so we have our basic information. This is what we need to calculate. Has everyone got this? I'm sorry. I'm sure no one has got it. No one is typing as fast as I am. Don't worry. You will be given time during the day to calculate all of this information. And I am not going to put this sheet on the Google Classroom. So you'll have to create the sheet by yourself, but I will give you sufficient time during the lecture. So don't worry. Don't be too scared. Okay. Information is put here. I will put this side justified because these are, I think, center justified in these fine. Okay, stay here. Now, average return is very simple. How do you calculate average? We use the formula average. Okay, select the two pieces of data, bracket close, standard deviation. What is the formula for standard deviation?
Is equal to step due.
Stead is okay. Now I've realized something new here. Okay, uh, you get standard deviation plain and simple. Okay, and you have a new functionality which has come up. I don't know if this is available this one with all spreadsheets. There is something called as stdev.s. Okay, standard deviation for sample size as such for some samples. Because if you look at the information we have here, we are not doing this for the entire population. We are not doing it for the last 30 years or so. We are doing it for a small sample of only 2 months. So when you do a sample size for a small sample, it gives you better results this way. But I think even the previous one is just as fine. So uh, we'll use the previous one just to prevent any sort of confusion. So select the two information, bracket close, we have standard deviation. Formula for variance. Formula for variance. Pupils. Listen, pupils. What is the formula for variance? Guys, variance. Hola. Hola. Am I not audible?
Equal to VAR.
VAR. Okay, so var is up. Okay, variance is done. For covariance also, I'll repeat the same thing. Covar, but the formula is different here. Ah, yeah. Covar, I need arrays. So I'm going to select first array, comma, select my sensex array and close. Now this is a little tricky. Do that well. First array, second array. And I realize that normally when I'm doing this, I have to hit Control Shift and then hit Enter. Don't worry if you get extremely small and insignificant values, don't worry about it. We've calculated all of this, and beta we all know it is covariance divided by, once again, so for this, first I'll have to copy all this information and post it for all up to Tata Steel. Oh, wait one second. For covariance, I'll have to tweak the formula. I'll hit F4 and I'll get my dollar sign. I'm hitting F4 because I don't want this formula to move as I'm moving. Okay, control copy. Be a little cautious on this point. Be a little cautious here. You want, when I'm using the formula, I want this bracket to move everywhere, but I don't want the second part of my formula to move. So I want to lock the sensex data for everyone. In order to lock it, I'm going to put a dollar sign. Put $n, $14, $n, $15, and that way this gets locked. So when I copy it, it moves ahead. Now I'll show you what happens if I don't copy. Okay, so for example, if I don't put dollar sign, what's going to happen? I'm removing the dollar sign and I hit control and I hit paste. See what happens? I get an error here. Why do I get an error? Because my sensex data has moved to the right. I don't want sensex to move. It is common for everyone. In the covariance formula, the covariance is nothing but the covariance of the stock with the stock market divided by the variance of the stock market. So uh, put the dollar sign. Don't forget the dollar sign. There you have it. All the information is here. Beta is very simple. You take one second. Before we do that, we need to calculate the variance of average return of these three as such too. So yeah, covariance of stock, and this one will actually, you can calculate it. You will get the answer 0. You can calculate for something. So let's calculate the beta. So beta is nothing but covariance divided by variance. So
Sir,
I get, yeah, tell me.
for beta, we can also use slope formula, right?
You can, but for it does not hold true under all situations as such. So in a narrow band, it is good, but in a broad band, I would say no.
Okay, sir.
Okay, so beta is a good indicator. Alrighty. So I have this now. Risk-free rate of return. I know what is the, in general we always keep our risk-free rate of return as if what money you get from the bank. Currently you get around 5% from the bank. So I put 5%. That is 0.05. Okay. Since the numbers are small, I'm going to add one more decimal point. Like, yeah. Now, please bear in mind, these are all monthly returns. Okay. So when you annualize it, the number becomes a little bigger. It's not going to be as small as this. So what I want you guys to do for today is generate this particular sheet. Whatever I have done from the start till now is your assignment. You need to complete this and you need to uh, let me just optimize this a little. Small, very small. Use this. Okay. Can call this as B Airtel as such. We all know what B Airtel is. Okay, this is done so that I can save some space. Yes. So I have everything on one nice piece, lovely sheet. Oh, sorry, made a mistake. Mistake. Yeah. I have everything on one nice, lovely sheet here. So this is your classwork. People get on the job. Start this. So today's session is more like a tutorial session. Like there's going to be a lot of handwork. You will have to do this by yourself. This practice is important because you need to have confidence in getting this work done when you go into industry or when you're starting to put in your own portfolio into place. Okay, I want all of you all to take a screenshot of this file. Take a screenshot. Now I want you to recreate this. Now the only way that I know, and after the only way you will get attendance for today is if you recreate this on your Excel sheet. And after you create it on your Excel sheet, you are going to show me a screenshot. Okay, you're going to WhatsApp me a screenshot uh, of this exercise. Now the reason I know that you're not going to send me the same information back is because when you write down these companies, my screen is on blue in color. I want your data to look this particular, this blue that you see here. This blue should be in some other color. Okay, it can be, don't make it too bright. It can be brown, it can be dark red, it can be, red is too dangerous actually. It can be gray, it can be green. You can keep it any, you're getting my point, what I want you to do.
Yes, sir.
So what you are expected to do is make this change, make the Excel sheet, use your spreadsheet on your mobile phone or use your computer. You're free to do whatever you want, but please keep in mind you have to recreate this. Take a screenshot. The reason I know you're going to edit it and do it by yourself is that with a screenshot you can't make these changes, or you have to be very good in Photoshop. And after you've done it, send me the details back. Now, uh, ideally, all of us should be on the same page. When I say this, I mean all of you should get the exact same values, because we are not taking any data which can be changed. All the data is the exact same data that we are taking from the internet, from the same source. So each one of you should come to the exact same numbers. If you're getting a different number anywhere, it means there is some mistake in your calculation, or some data you have been like me and you've taken, instead of opening, you have taken closing, or you have taken the high or the lows, you've taken some mistake into this, and rectify that mistake, and you should be back in order. Is that okay?
Yes, sir.
Yes, sir.
Okay. So with that,
Sir,
yeah,
sorry, that six number is risk-free return. After that, what you have written?
अरे right up to risk free return first ना, total
Okay, sir.
risk. साला जो है वो नहीं करेगी, पहले दूसरा पूछने वाली. Have you all taken a screenshot?
Yes, sir.
What about the others? Oh, sorry,
Yes, sir.
forgot the camera was on.
Yes, sir.
Okay, so what I'm going to do is I'm going to get on to another part. I'm available here if you need any help. Give me a second.
Sir,
Yeah.
12 to 1:30, sir, it's a break time of us.
Why? My lecture is after that, right?
Yes, sir. So we should continue the lecture or we should leave the lecture.
Continue the lecture.
So no break.
Alright? Life needs a break, yeah? What is break you want? Spending time doing Excel, working with me. Why do you need a break? This itself is break.
So your second lecture is at 3 o'clock.
What? Acha, then what lecture is right now?
Yes, sir. Yes, sir.
1:30 we have strategic management lecture. Tomorrow you have two continuous lecture of 11 to 12:30 and 1:30 to 3 o'clock.
Oh, that way. Acha, what time is the break then? 12:30.
12:30.
12:30.
Okay, ठीक है. So what we'll do is 3 o'clock. Let us what do you call?
That
Get back.
also it is 3 to 3:30 only. I don't know. I think HOD is having some other plans or something. That is also for half an hour only.
My second lecture, yeah.
Yes, sir.
ठीक है. We'll figure out something. Okay. So with
Okay,
this,
sir.
with this, one second. Okay, what we're going to do is we'll end today's. We'll end today's session, not today's session, this morning session, and let us catch up at 3 o'clock, and we will complete the second session at 3. Okay. One
Yes,
second.
sir.
Hey,
Thank you, sir.
hey, give me a second. I'll just take attendance. Yogin, you'll do me the honors. You'll take the attendance and send it to the librarian.
Yes, sir. Yes,
Thank you
sir.
very much. Very kind of you.
Guys, please wait 1 minute.
We have full attendance today, I think. 25, not bad.
So I think so. It is full attendance, but still I will cross check once.
Yep. Sem 3, SAPM.
Yes, sir. Done. Only one is absent.
Okay, who's absent?
Ramila.
Okay, take care. So, okay, guys, with this, I shall see you at the second half of the day. Take care.
Thank you, sir.
Have a wonderful time.
Yeah,
Bye
you
bye.
too, sir. Bye.
Thank you, sir.
Thank you.